All right, what's up, everyone? This is Kirk here again at Option Alpha. I very much appreciate you all joining me here today. It is 2 o'clock Eastern time on the 20th of September, and we're going to have a really good session today talking about perfect expected value, so theoretical expected value, and then looking at some research on what actually happens to positions after they hit their expected value or go through their entire life cycle and actually get to expiration. So, trying to figure out, does this theoretical expected value stuff, this mumbo jumbo, does it actually translate into something that you can rely on in your trading? If it does, how can we use it? If it doesn't, how can we adjust our strategy around that? So, really quick note before we jump in here, I really appreciate everyone jumping in here. Got a lot of emails from people, which was actually very, very interesting. A lot of emails from people after we sent this out that were super, super upset that I scheduled this basically at the same time the Fed announced today at 2 o'clock. And it was on purpose, it was deliberate. And the thing that I just want to say about this, because I think it's really important for those of you listening, it's like, one, the Fed has never predicted anything successfully in their life. Two, they've never even predicted their own actions and guidance. So that doesn't matter anyway. The markets are going to do what the markets are going to do. But if your strategy relies so heavily on watching the Fed and reading the keywords and hot topics that they just regurgitate over the last 8 meetings anyway, you probably need to do something different. So I deliberately did this on purpose to force people into making a choice to get away from the stuff that they're doing before, which is like gluing to these people that are on TV telling you what the market's going to do or not, and they have no clue anyway, and try to get you some education, some learning that actually might help your trading. And so that's what I hope to do here today. So hope you guys enjoy this. Let's jump into the slides here. I've got some slides and then we'll go back and forth on the platform here. But I think you guys will get a lot of value out of this. There's lots and lots of links. We put links to this not only on our blog, but also inside the Tradier Hub. There's links to this research in there so you guys can find that as well. And you can take a look at this, okay? But when it comes to expected value, if you caught our last show, we spent a lot of time going through what is expected value, how do you calculate it, why does it matter as a trader? And so we're going to cover a little bit of that just very quickly at the beginning here. But more so than that, today what we want to figure out is, does expected value actually play out the way that it should in theory? And this is a really important question, because if the basis of what we're trying to do for some of our trading is to use expected value to make sure that the numbers and the math of the position that we're trying to go after, if that is a good trade to get into, then the next logical question is, okay, once we get into that trade, how much can we rely on this expected value calculation? How much can we rely on volatility as part of this equation to get us to the point of feeling comfortable letting these trades play out? Because once you're in a trade, you got to let the trade play out. You got to cross this chasm. If that's why I always say, like, you have to cross this risk chasm where you actually have to hold the position from entry to exit. And is that worth it for you to play out? Okay. As a quick reminder, by the way, since you all are joining here on the Tradier Hub, remember that when you connect your Option Alpha account to Tradier with a qualifying account, you get Option Alpha for free. So if you're watching all this stuff today and you're thinking this stuff is really cool, I want to use it, well, you can get it for free just by connecting your Tradier account to Option Alpha. This means that all this stuff, all these tools that we're going to be talking about, totally free if you connect your Option Alpha account. Okay, so really quick refresher. What is expected value? Remember, expected value, and we covered this in the last show, so go back and watch the last show if you want to get an in-depth dive into it. But just really quickly, like, cover a couple of things here. Expected value is a fundamental concept in probability theory that provides insights into the outcome or value of a random set. So the expected value of a coin flip is 50-50 heads and tails, right? So that's really, or the expected outcome of that coin flip. It's kind of basically trying to figure out a way for us to calculate the likelihood of each subset of P&L expectations of occurring in the future. So what's the likelihood that I make, my max profit? What's the likelihood I make my max loss? And what are all the likelihoods I make those variable or partial profits and losses in between on positions? So to put it simply, EV is just the weighted average of all of these possible outcomes for a trade that you're looking at. Now, if you're not even calculating EV, you probably need to start doing it. You can do some simple EV calculations. They're probably not as powerful as doing automated EV calculations that take into account all random points along the P&L curve. But regardless, it serves as a powerful tool for your decision making because you can easily see if a trade has an edge, a theoretical expected value edge built into it or not. It's just another way of saying, are you getting paid and compensated for the risk that you're taking? And if you're not getting paid and you're not getting compensated for the risk that you're taking, why make the trade in the first place? That's what I think. So remember, any individual bet trade that you could have could be a winner or loser. And what matters more than the individual trade is the expected outcome after many, 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 many trades. Do you guys agree with that? So it's not that you look at a trade and a trade has, and we'll go through some here today, but like you look at a trade and that trade has an expected value of $10. That doesn't mean you're going to make $10 on that trade. It just means that if you make trades like this over and over and over again, that the expected outcome when you subtract all the winners from all the losers and net it all together, they should be up about $10 per trade that you do. And so what we're trying to figure out today is, does that really hold truth? Does that really matter? Like, does that actually happen? Okay. So remember, this is the expected value calculation. We're calculating all the possible data points in here for your P&L, your max profit, your max loss, and all those partial profits and partial losses. And we're summarizing all those together with the probabilities to figure out, are you net going to have a positive expected outcome or negative expected outcome for your position? Okay. Now, again, inside of Option Alpha, we do the heavy lifting for you. We calculate this for your positions. We do this inside Trade Ideas. If you manually pull up a trade and you just start to mess around with some of the filters and some of the legs or the expirations, we recalculate it on the fly automatically for you. So there's truly no guesswork involved. So there's no manually calculating it. There's no downloading data and spreadsheets and running your own Black-Scholes analysis. So you don't have to do that. You can just literally go in Option Alpha and use it. And you can see these are positive expected outcome trades. And these are just sorted by positive expected outcome per contract. So then you can scale up or scale down or position size accordingly as you see fit. Okay. So here's how we went through the research. And if this is helping out, let me know in the comments. I'd love to know how you guys are doing here as we go through here. So this is really kind of where the rubber meets the road. Truly to me, like, and I even was telling our guys this morning, like, this has been such an impactful series of studies that our team has done, that it's literally going to change the way that I trade moving forward, no doubt. And if it's not that impactful for you, I don't think you're paying attention closely enough to what I'm about to show you, because it really should be something that truly moves you in a different direction in your trading. Now, look, all credit goes to our team, Rob, Matt, Steve, these guys for running this. I didn't do this research. They put it together. They put the hard work into it for you guys. I just get to present it to you. So we analyzed 130,000 positions across 155 different underlying symbols, which means that we weren't just looking at SPY. I truly am fascinated by studies that are out there from other people that just look at SPY. Like SPY is the only possible trading vehicle on planet Earth. No, you should be trading other things, and it should hold weight across lots and lots of different ticker symbols. So we tested it across 155 different symbols, ETFs, stocks, everything, to compare each trade's realized P&L. And this is the most important point. Each trade's realized P&L to its expected value at trade entry. And so what we're trying to figure out is, in the case of like a snowman, if the expectation is one thing, is the reality something different? So if we are expecting to get X, do we get X? If we're expecting to get Y, do we get Y? Or do we get something else? And if there's a huge mismatch in expectation versus reality, then we can't use it, right? Do you guys agree with that? And so that's what we were after. We were after trying to figure out if the expected value, before we know how the trade's going to play out at the end, if the expected value is $10, after lots of trades, does it end up at $10? Does that make sense? Now, don't cheat. If you're in here right now, do you think that it held? Do you think there were certain ranges it held? Do you think that it worked better for low expected value versus high expected value? You can add a comment in here. I'd love to know. Okay. So here's how it worked out. This was our first series of buckets of trades. Let me show you, just kind of walk through what this P&L diagram looks like and kind of what this research looks like. But this is probably one of the most impactful charts that you should have trading. If you don't know, if you like have trouble understanding it, rewatch this a bunch of times. It's so powerful. Okay. So the first thing that you have on the left-hand side, right? The left-hand side here, this is your the y-axis, right? Is this the y-axis or x-axis? Yeah. So this is your average P&L. So this is the zero line is right here. I think you can see my cursor here, hopefully, but you can see the zero line. So the average P&L for a trade, and this goes up from 0 to 130 and down from 0 to below, right? And then down across the bottom, we basically bucketed expected values. Now, some trades, as I showed you a couple slides ago, some trades have expected values that are like $68.73. Okay, so we didn't plot $68.73 here, but we did buckets of ranges. So $10 buckets, right, with no fewer than 250 samples inside of there, so that you could see if the expected value was $30, where did the trade generally end up? Did it make $30? So let's use this as just a guidepost here for you guys so you can see. So trades that were in the $10 bucket here. So it's a little bit off because we shifted this diagram here to go into the middle of the graph here, but you can see that trades that were in the $10 bucket of EV actually had expected values that were about $10 once all the trades played out. Now here you can see the number on this data point. That was the trades that were in this bucket. So trades that started with an expected value of $10, there were about 17,600 trades. So a pretty significant sample size, more so than you would need to be statistically significant to say without a doubt that what happens here is that if you have a trade that has a $10 expected value, then you're going to get about a $10 expected value once lots and lots of trades play out. Okay. Does that make sense? So these are and this is again, snapshot in time of from trade entry until the end of the trade, all the way to expiration, not taking profits early, no stop losses, nothing. Just letting the numbers play out. Yeah, Rand asked the question, are these gains, losses at expiration? Correct. These are all the way played out at expiration. And so this is really important because we just wanted to, before we did any profit taking, before you do any stop losses, which we might cover in other series and research articles on this. We've covered it before, but we might add it into this. But before you do any of that, just letting the pure probabilities play out. Did they play out the way that they should? And so this was really fascinating. And what you found is that as you got more data points, that average P&L line started to correlate tighter and tighter to the theoretical perfect implied expected value of a trade. I don't know about you guys, but that is game-changing information for traders. Now, important parts here, you got to calculate EV correctly. You got to take the partial profits and partial losses, which nobody does. You got to make sure that you're including that in there. You can't just take the simple expected values and hope for the best. You got to take those partial profits and partial losses into account because they matter. But the more trade data that you have, the more that you can show that line, or the more data you push in here, the more you show that it's compressing and correlating around that theoretical perfect expected value. Now, if you guys actually go to our blog, we just published another round of research today, which literally just hit about an hour before I went live here. And it showed even more data, and you can see how it's starting to correlate even tighter and tighter with more data. Okay, so this is totally cool that you can see this. Does that make sense? How this kind of works out? So if you go up here to say the $40 to $50 bucket up here where I think you can see my cursor on here. Can you guys see my cursor when I do this? I don't know if you can or not, but it's the 3K, it's 3.2K. So 3,200 trades, right? So not as many as 17,000 trades, obviously, but still statistically significant, lots and lots of trades. You get up to that range and you start to see that the average P&L is actually a little bit higher than the theoretical perfect EV. And so what happens here is that as it starts to go above and below these, then that's just representing that until we have enough trade data that it's temporarily moving with the market and may be over accounting for risk or under accounting for risk in pricing, but generally you can see that the line follows that trajectory, which means that for all intents and purposes, if you have a trade that has positive expected value and you held it all the way, you should net positive expected value as you continue to go. Okay. Yeah, there's definitely going to be variance in here. So Tony had a good question here. Did periods of market trends or volatility changes, other factors cause variances between it? Of course it does. So this was all still done during low, call it VIX. I think I even said in here in another one of these slides, like lower VIX levels. So we haven't really seen enough data at the super, super high VIX levels to say, hey, it still works at these levels, but that's what position sizing is for anyway. You should be position sizing down. You should be trading uncorrelated asset classes. You should not be doing all of your trades on one side in one ticker and hoping that it works out, right? Like there's some basic portfolio mechanics that I think should work to your advantage here if you continue to do them. And I have a test portfolio that we've been experimenting with that I'll kind of show you with that as well. But of course, they will start to ebb and flow. But the gist of it is that it doesn't matter as long as the expected value is being accounted for in the risk that you're taking. So as long as you are accounting for the fact that there's volatility, whether it's high or low for that particular period, that should be accounted for in capturing positive expected trades that should account for that risk. I don't know if that makes sense. We'll keep going through some examples. So here's some other things too. Now, when we looked at this data, this particular data set, so you know, we did not include anything that went earnings or ex-dividend. And that's really important to consider here too. And you can do this inside of Option Alpha where you can automatically exclude earnings for any of your trades or any ex-dividend dates. You should do that as part of like a standard process if you want to. It's part of your strategy. But just so you know, we took pure trades that went through expiration cycles without the impact of additional unforeseen factors like earnings and ex-dividends, okay? If we, and we'll get to that here in a second, but what happens is that when we factored in earnings, and that's really cool to see too, when we factored in earnings and we included earnings in here, you can see that the numbers went crazy. And basically the match or the correlation that you had between the average P&L or actual P&L and the theoretical perfect expected value basically broke. And you can see this visually on the chart. Basically nothing worked, right? I mean, maybe like the zero barriers. So somewhere around here, the zero expected outcome, zero average P&L, that was all a push. That was like, that's your net zero sum game, basically, that people trade around earnings. Sometimes they work, sometimes they don't work, right? And then you go for those really high expected value trades where you just don't actually get that value. You don't capture that value because earnings are so unpredictable. We've talked about this for years. We stopped doing earnings trades years ago because the original research we showed just shows there's really nothing that you can do about it. They're so unpredictable and can last so long that's really probably best to just flat out avoid them. And so the key point here that you have to really get at home is that you cannot use expected value across these major asymmetric events that happen like earnings that are just kind of really random outcome events that you need to manage around. So just don't trade those. Don't worry about them. Enjoy the news and like enjoy hearing about it. Let all the other traders trade those. You stick to what you're going to do, which is your core stuff anyway. So again, when we include earnings, our average P&L line is not correlated to the perfect EV line whatsoever. So therefore, EV and probabilities in general cannot be relied on for accurately estimating future potential outcomes or trades. Okay. Tony had a good question. Doesn't this research make a solid case for holding trades to expiration with limited concern for assignment? Well, I think that is the concern, truthfully. I think that, yes, in a world where everything was cash secured or cash settled, then theoretically you hold all the trades to expiration. But I think there's definitely still a case for managing the position early because you don't want to get into the cycle of having lots and lots of trades assigned and having to deal with that capital. Like personally, for me, that's a consideration for now going towards this strategy is like, how do you manage around that? How do you maneuver around that? I think there's a universe where you capture 80% of the potential profit and get the trade off early or exit the trade a couple days before expiration, or monitor inside of your bots the level of extrinsic value that's left in those contracts. And once the extrinsic value of, say, a short call option that's in the money or a short put option that's in the money, once the level of extrinsic value or time and volatility value gets sucked out to a level, then exit the position, whatever that ends up being. So I think there's ways that you can manage around that, but I do think it's still a concern. But yeah, it does build the case for sure of foregoing all the other crap, for lack of a better word, foregoing all the other crap and just making sure that your trades are priced appropriately. And that's sometimes a hard thing to do, is like finding trades that are priced appropriately. But it's pretty obvious when you look at the big ones that have huge discrepancies, which we'll go through here in a second. Okay. All right. So we're not done yet. So let me just switch over here. So I'm going to stop showing that, and I'm going to switch over to my other screen here. And I want to share some stuff inside of, let's do this tab here. All right, so let me go through trade ideas. I think I can show this. When this pops up here, do you guys see this new position screen? When that pops up, I just want to make sure so I can, yeah, it does. Okay, cool. So look, so inside trade ideas, I just want to show you how you can find these. And then I'll just want to talk through a little bit, but just like trying to understand just a little bit about this. And I'll just anecdotally put as much like emphasis on just kind of understanding a little bit of the nuances here and kind of talk through them. I don't think I can get to everything here, but just things that I think about when I go into trade ideas. By the way, when you go into Option Alpha and you just want to add a new position, if you just want to add a new position, and let's say you want to do a short call spread and you want to do it whatever the date is, once you actually put in all of your criteria, then it will calculate for you your expected value. So notice, if you can see right here, it's going to calculate that expected value for you on the fly. So you don't have to go to trade ideas to accomplish this. You could just say, hey, I just want to make a trade in SPY today, and I want to do XYZ. So let me just make this a little bit more favorable, and maybe I make a trade like this. Now this trade right here, it's got positive expected value, and that's great. That means that if I were to make this trade over and over and over and over again, I should end up netting about $18 for one lot of this trade. That doesn't mean that I'm going to make, and it's so important I say this again and again because people still don't understand this. It doesn't mean I'm going to make $18 today on this trade. Does everyone understand that? It means that the expected value of this trade, when you actually price out the probability of making your max profit, the probability of your max loss, and then all of the little probabilities in between there for your position, the probabilities end up netting out around an expected value of about whatever it is as it's moving. It's like $19, $17 as it goes. So if you're not doing this already, if you're not actively going in and pricing out your trades to make sure that you're taking in enough money to cover yourself and your risk in your trades, then you're not doing a good job as a trader. You're really not. You're not serving your own purposes. You're killing yourself. You're shooting yourself in the foot because you're literally taking trades that don't work for you. All right. So if I go over to trade ideas here, just to show you how I kind of do it, I usually do ETFs or watch lists, which is mostly ETFs anyway. I'll go to a date range. And this is very subjective to you. If you want to go to longer date ranges, you can. It works a little bit better because there's just more data on the shorter date ranges. So you could go something like 10 to 15 days. I'm just picking something out here so you can see how it works. And then what you can do is you can go to probability of profit and say, I want a probability of profit 70% or higher. Now, does this mean that these are all the best trades? Of course not. You could do probability of profits 50% or higher and still find trades that have positive expected outcomes, right? But I like trades that are a little bit higher probability of profit. I want to get some consistency, some momentum. I don't like to have this flippy floppy, like win one, lose one, win one, lose one, etc. And once I get to this, then I can really start to see all the different possible outcomes here. Now, if you want to, you can sort this list by expected value. That's not always the best way to go. And the reason it's not always the best way to go, and I'm just throwing this out there so you guys can see this too as you go, is that if you sort it by expected value, sometimes, like right now, you will get trades that have a really high expected value. But it also has a really high max loss because these positions are just naturally wider positions. Look at the spread here. This is the 444 call and the 460 call. That is a huge position, which means if you want to capture that $59 expected value, you're going to have to make this type of trade a lot, like over and over and over and over again. Now, if you can afford to lose $1,200, maybe 2, 3, 4, 5 times in a row, by all means, knock your socks off, take that trade. Does that make sense? But that max loss is something I really kind of look at for positions personally, because if that max loss is too great, even though the expected value might be very tempting, then that max loss leads me down a path of putting myself in a position where 1 or 2 bad trades knocks me out of contention. I don't know if that makes sense, but 1 or 2 or a sequence of bad trades can completely knock you out on this type of trade when you've got too big of a potential loss. Now, some traders like it. I personally don't. So what I like to do is I like to sort this list by alpha instead. It's a different way of looking at it, but alpha basically takes the expected value and it divides it by the max loss. So you're kind of getting at this value of like how much expected value per unit of risk am I taking? It's a really interesting way of looking at trades and trying to, I guess you could say, like normalize a lot of trading data across different various ticker symbols and different spread widths and different expirations. So that's the way that I like to do is I like to sort by alpha. Again, from even in here, this is a really good alpha trade. That's still that one that is a high ranking alpha trade, but the max loss on this position is just too high. So I might take a trade in here, or I might take a trade right here, which is like a $200 loss. That's kind of more of my wheelhouse and comfort zone. That might be a trade that I would be more willing to put on personally because it's just a smaller trade that I'm willing to kind of rinse and repeat and let continue moving forward. Okay. So does that help out? Any questions on that? Just let me know in the chat really quick. And we can make sure we can answer those. Did index EV values deviate too much during the earnings? Yeah, we didn't have those. I mean, you don't have those in earnings because you don't have those across earnings. So it doesn't really matter. But during like earnings season, no, not really. Yep. Someone said, is the data consistently updated in trade ideas? Yes. So it's actually updated every single minute. So when you refresh, you could get a completely new set of data. What I like about trade ideas personally is that because it updates every single minute and it literally goes through millions and millions and millions of possible spread combinations and runs this data, you could be looking at something that literally exists for 2 minutes in time and is never there again. Like the pricing works right now and it works right now to get into it, and then it doesn't exist. Okay. So that's why we have to update these all the time because they do go in and out all the time. Okay. Moving forward here, here's another thing I wanted to show you. If you sort this list of trade ideas, which is just a database, so it doesn't mean that we're suggesting or recommending any of these strategies or trades because we're not, it's just a database. You can see here why some trades are really, really bad trades because they have not only because they have negative expected value, but because you're taking enormous risk and just the math doesn't work out. Like if you look down here at this potential trade, so let me just load up this Iron Condor and SPY. This Iron Condor and SPY, we're already telling you has negative $18, $19 of expected value, right? But intuitively, you could just look at it and say, look, I'm potentially going to make $400, which is a little bit over a 50% probability of profit. And when I lose, I'm going to lose $600, right? Which the probability of that is 16%. Or I'm sorry, the probability of that is 16%. There's a really good disparity here, not in my favor, where I'm just not getting compensated enough for the risk that we are taking on these positions. And that is the power of understanding expected values. Is you can see now, do you guys see this? Can you comment in the chat? Like, just let me know, right? Can you guys see how this it doesn't make sense? Like the numbers don't even add up. If we just even hid that and we just took away expected value, you'd probably do some rough numbers in your head and be like, "Ooh, that doesn't make sense at all," right? That doesn't make sense at all inside of here. If you look at some other ones that are probably a lot more, like the disparity is huge. Here's one. You make $96 if you win, and you've got a really high probability of profit. But if you lose, which you got a pretty decent chance of losing too, you lose $1,000. I mean, you could easily see you've got to win 10 times in a row just to catch up to the other times that you lose. It's just not enough. And so you can see in here that these trades don't work out as well with negative expected value. By all means, go ahead and try them out, but why would you do that moving forward if you can help it? Okay. All right. So the other thing I was going to show you guys too is I wanted to show you this tab. Can you guys see this now? This pure EV portfolio. Now look, this has been an experimental portfolio that I've been running, and the purpose of running this was because what I wanted to try out was I wanted to try out a bot or a series of bots. I think there's 36 bots that I run on this, a series of bots that purely trade expected value, nothing else. In fact, I even told the bots inside of the trade ideas action, which I'll show you here in a second, that there's no, I didn't say you had to trade a put spread, a bullish put spread. I didn't say you had to trade a bearish call spread. I didn't say you had to trade an iron condor. I said, here are my parameters. I want this premium. I want 70% or more, and I want a positive expected value. That's it. Purely that's it. And run them mostly to expiration. I think I took profits really high, 80, 90% on these, and just run them all the way to expiration. And so far, kind of I guess you could call it somewhat out of sample expectation here, is that it's done about 626 trades. Win rate's been pretty good. Profit factor's above 1, which means that if I put in $1, then I should get $1.30 out with a profit factor of 1.3. And it's had some volatility for sure, but the return on risk that I have and my holding period on these is not too long. And so it's actually done really well. The interesting part to me is that if you take the trades, and by the way, it skipped all earnings, by the way, so it would never trade through earnings. I said, don't trade through earnings, don't trade through dividends, like stick into the program. Is you have some of the tickers that, and most of the tickers were good. Some of the tickers didn't do so well yet, but you have these outliers on either end that are big tech names. So like Microsoft in this case is our best position right now, our best single ticker symbol right now. I don't think that that's actually how it will end up. I think it just happens to be right now. It's only 22 positions, 20 wins, 2 losses, great. But it's a huge outlier because tech moves very erratically, right? And then you have Tesla down here, same thing, 16 positions. It's our biggest loser. So I think that what we're starting to see now is we're starting to see that the stocks that have greater volatility, maybe more earnings-like movements outside of earnings periods, right? The stocks that move based on a tweet from the CEO or a not tweet from the CEO or whatever, those stocks that move like they're in an earnings environment without even being in an earnings environment are the ones that maybe should still be avoided, the earnings-like positions that start to be avoided. But everything else in between has generally been okay. I've also seen that this thing has done a lot of iron condors, call spreads, short put spreads haven't worked out so well, but it's done way more iron condors, 372 positions. It's made a lot of trades, but generally it's done pretty well. So this is one that will now be starting to convert the process of taking some of these live and start to move some of these over. Okay. Does that help out? Does that make sense? Any questions on that right now? So you can see like both the data set and then starting to see one, how you should probably potentially do some testing around this and put some of your theories or some of your tweaks or stuff that you have there and start testing this out into a paper trading portfolio before you start converting those over in the future. Okay. Tuck Plain said, does EV take into account managing trades early or as a result of letting the trades run to expiration? In our study that I showed you, that was purely letting trades run to expiration. In this case, for this pure EV portfolio, we did take profits early on things like 80%. So it was basically buying back something at a penny, essentially. So, or like 2 pennies. If it got down to really low price, we're going to buy them back. In the case of the research study, we could let it go and capture the extra penny or two, really going to make a big of a difference. But if you have a high profit target, you're probably going to capture these really well. Okay. On rate of return, doesn't average days in trade of say 30 days or an EV of ROI 5 translating to annualized 60 is that turnover risk of capital. Yeah, I think there's a huge risk of turning over that capital a little bit too fast. And obviously it doesn't account for assignments in here yet. So because we're trading paper trading, so we can't essentially do assignments in here. Everything runs to expiration. I think if you had some assignment risk in there and if you couldn't manage that assignment risk, it could reduce that down. But I think the turnover of capital is going to be a huge component. I think that position sizing is also going to be huge. In this case, we're allocating a lot to this EV portfolio. I think this EV portfolio has an allocation of like 111,000. So you're allocating a lot of capital to it, and you got to make sure you spread across. How many trades per day does this bot open? So let me actually show you how I set up this one. So let me stop sharing that tab. Oh, did I mess up the tab sharing? Well, let me get back to it. I got it. Hold on. Okay, here you go. So this is how this one runs. Okay. And yeah, and I'll make it available or clone. A lot of people have already made their own versions available in the community. They just take what I'm already doing here. But whatever one I start to eventually run, I'll of course make available, and you guys can clone or not clone or modify or whatever you want moving forward. So here's the pure EV portfolio. It's about 37 bots. So, and I just did this to test lots of different ticker symbols. You'll notice on the left-hand side, the orange are testing regular stock symbols versus the blue is testing the performance on ETFs. So I was just testing a lot of different symbols. Some trade a lot more than others. Everything was basically given about $3,000 allocation across the board and basically said to get into as many EV trades as you could possibly get into. All of these bots use the same automation. And that's the coolest part about this is even though I'm running different bots, because I want each bot to have its own ticker so that if it doubles up or triples up on trades, it knows exactly what positions it's got for that particular symbol. So I run each bot in its own ticker symbol, which is what I've done naturally and what I think you should do. That's really the purpose of it. You could smash a couple ticker symbols into one particular bot, but because bots can share automations and this bot shares the same automation across all the different ticker symbols, the only input it has is the symbol itself, then any changes I make to this can flow through to the rest of the bots anyway. So in this case, I tell it that it can open one position per day, a limit of 10 at one time. It's going to manage all those, so it doesn't matter, but I want lots and lots of trades and lots of occurrences. And because I've position sized everything down, I can get into lots and lots of trades for each individual symbol. This only has one action in here, and the action is to find a trade idea that is 7 to 14 days, take profits at 80%, and then take the trade off 15 minutes before expiration. So you're literally running it as close to expiration as possible. When I convert this thing over to live and start doing it, I'll probably do some more stuff around that to manage that expiration risk, like I talked about earlier, managing and taking a look at extrinsic value of the short strikes, maybe taking profits at different points if I got them earlier or fast enough in the process. But I'll go over those in the future. In this case, some of the position criteria that it has, so mid price between 12 cents and $15. The $15 is just a super high end range, but this basically gets us from selling premium that's super, super low. So originally in testing, we were selling premium that was like $2, $3. And you basically have to let those go all the way to expiration to capture that full amount. So we just basically said, hey, look, we're not going to do that. We're going to capture some of these positions in here. Expires before the next earnings report. You can do no ex-dividend dates. EV per contract is greater than 0. This is super fascinating. I think what I'll probably end up doing here, just because of the slides that we went through earlier, is I'll probably end up scaling this up to something around maybe $10 or $20 just to get like the highest EV capture trades that work with the biggest data set that we've seen, or the most like statistically significant, highly tightly correlated to pure EV. But right now in testing, I just did more than 0. Like as long as EV was positive, get into the trade, 70% probability of profit. And I do personally max loss per contract less than $500 because I don't want to get into great EV trades that have a super, super high max loss. So I deliberately reduce the max loss. You can do whatever you want there. Again, the tighter that you make these requirements, the more digging that it's going to have to do to go and find trades, which means it might not find trades that often. So you got to play that balance of getting enough trades in while at the same time making sure that they meet your requirements. So sometimes this bot does a lot of trades. Sometimes it does a little trades. It just depends on the day. So I know Daniel asked a question, how many trades per day? I mean, all of it depends on the market and the bot setup that you have. You can make it really loose. You can make your pricing really tight. You can make it really aggressive. And then it's just market dependent on where you can go from there. So while on that page, will all the settings flow through to all the bots? Yes, correctly. Yes, all the settings for this will flow through because it all uses the same scanner automation. And then you can basically just use that same scanner automation for all of your bots. So as soon as I make a change here and just save this, it flows through to any bot that is using this same automation moving forward. Someone asked, is there a way to backtest trading ideas on different time ranges? You can't backtest trading ideas because they're just market dependent at the time, but that's what the research is that we just went through today, is essentially research of the trading ideas and expected value versus the actual. So, I mean, that was basically the best backtest you could have ever seen. Expected values that are positive end up being positive expected P&L or positive real P&Ls when you let them play out. So take that and run with it for your positions. Okay. All right. Was this helpful today? I know we are running short on time here, so let me know if you guys have any other questions, but I hope this was super helpful. I hope this was way better than listening to the Fed or any of those talk about whatever is going on in the market or not going on in the market, but I really hope you guys enjoyed this today. If you did, you can check out the research that we just did. Like I said, Rob and the guys just posted another series on here on the blog. It's right up on our blog, optionalpha.com, so you can go up there and grab that with even more data, and you can see that. It's really, really powerful stuff. If this hasn't changed the way that you think about your trades, you should rewatch this again until it does, because it should. It should really, really move you in how you price your trades and making sure that you're at least capturing positive expected value on trade entry. If you don't know if you are or not, then you probably are not, or you need to figure out a way to capture it or to calculate it on the fly, because it's that important moving forward. Okay. Someone asked a question, how do you manage adjustments on so many positions? I don't think you need to, with all these positions, for me, it would be I'm in the position and then I take profits or I close it at expiration. As far as adjustments go, because you've got so many positions and I want lots and lots of positions so the numbers work out over lots of occurrences, then I won't be making ridiculous adjustments to each position, because I don't really care about each individual position. I care more so about the summation of all positions combined. So if you're laddering into positions where you're doing a contract today, a contract tomorrow, a contract today, a contract tomorrow, then it doesn't matter as much to make adjustments, because you're naturally adjusting with the market every day that you move, and you adjust to different strikes and different pricing. Versus what a lot of traders do is they throw up this big position on the market. They go, bleh, and they like 50 contracts today at this price, at this value. Well, yeah, then you got to watch that a little bit closer, because if you just throw up 50 contracts on the market and that was it, that was all for you, then yeah, you should probably watch that a little bit closer and do more adjustments. I'm not saying that adjustments are bad. Adjustments are great. I'm just not going to do a lot of adjustments with these. You can program your bots to do adjustments if you want to. And it's a little bit more complicated. It's an advanced thing, but I just won't do it. I'll just use reoccurring entries as my natural adjustment. Okay, cool. Thanks, Michael. Appreciate it. Glad you learned a lot. WA, hope you learned a lot as well. Thanks for coming. Appreciate it. Thanks, Rocket Robin. I appreciate it. So, all right, I'm going to leave you guys there. Thank you all so much for coming here and joining me here today. If you have any questions, let us know. And until next time, happy trading. Take care.